AI will definitely disrupt certain classes of real estate, and I think some will not exist.
It's business, it's straight business. So you got to come
Correct.
solutions. Yeah.
I built a Claude program. I put in the 21 Nobel Prize winning authors on real estate underwriting and development, multifamily cap rates, IRR structures, and I put it in there. And in around 15 minutes, I uploaded my deal, and in around a minute and 30 seconds, it came up with 21 different ways to value add, underwrite, add something different, an ecosystem. How do I create a higher rent premium? All that stuff. Once AI can teach AI to do that like us, the processing speed, the intellectual capital, we're not gonna be able to compete with it.
Welcome to Common Denominator. I'm Moshe Popak. Jerry Katz is a real estate entrepreneur, insurance strategist, and founder who has insured billions of dollars in Florida property. But before he became an expert in using insurance as a profit lever, he lived through the dot-com bubble, Wall Street excess, losing everything, rebuilding himself, and learning that business is not just about making money. It's about solving problems. But more than anything, we talk about values. Faith, relationships, humility, and why the best deals happen when you focus on creating value for everyone else first. Hi, Jerry. Welcome to Common Denominator.
Thank you. Thank you so much, Moshe. It's a pleasure to be here.
Thank you. So what would you say? I mean, I've talked to a lot of real estate people, and I kind of geek out on real estate. It's my passion. That's what I do. Where do you think we are as far as real estate here in South Florida at this point?
I think, I get this question a lot, and I would say we're in a better place today than we were 12 to 18 months ago, right? And why do I say that? Well, first of all, if we talk luxury real estate, right? I believe that luxury real estate is selling out, and I can show you statistics and facts, things like the Ritz-Carlton, 85% sold, right? The Dolce & Gabbana building, 58% sold. So due to what's happening in New York City, obviously with politics, due to what's happening in California, the taxes, Seattle, what we're seeing is a migration of ultra high net worth. So where people are, the median price in Dade County has come down 10 to 12%. Yeah, let's call that workforce housing if you want to call that, but it's not, right? It's the median price housing. But the capital that's flooding into Florida is selling out ultra high net worth luxury projects. And it's shocking. And like the condos can go up to 2, 3, 4,000 a foot. Obviously, you see what happens at the surf club, the billionaires that are moving in, the CEO of Starbucks. I can go on and say the names. Obviously, Mark Zuckerberg, and now there's a rumor of Elon Musk, right? So in my opinion, when the top of the market resets to higher prices per square foot, houses on Star Island, you and I have been here for how long? 10 years ago, 8 years, they were $10 million.
Yeah.
Today they're $100 million, right? Or so when you reset the top of the luxury market, the rest of the market starts to reset to the upside, right? Just as a natural, fluctuation statistically, whatever you want to call it. So I think it's good. Now, if we go back into commercial, residential, all those things. Yeah, some people say we have too much new multifamily coming online. I think a new project started on the river, 6,000 units. They broke ground today on the Miami River. So as they say, we have a little oversupply on new construction multifamily, things of that nature. Yeah, the market is probably taking longer and things like that. But if I go back 24 months ago, where post-COVID rents shot up 30, 35, 40% across the board, and we had this whoosh, right cycle. And on the multifamily world, you and I were paying $160 a door, right, for a $1,400 rent. The rent shot to $1,900, and then you and I paid $235 a door, $240 a door, things of that nature, 5 caps. I think that era of all those transactions, all that rent increase, put our market into an overvalued position. Over the last 24 to 36 months, that market has stabilized, meaning the cap rates are better. Interest rates have leveled off, and we're used to it for the last 24 to 36 months. It's not 3%, right? It's 6%, 6.5%. It's stabilized. They're not moving. And at the same time, sellers who thought they could get 250,000 a door 36 months ago realize if I have to sell, I'm not getting that. I got to go back down to 210 a door, 220 a door, a rational cap rate. So I see transactions where 18 to 20 months ago, because we do a lot of insurance in that business, and on transactions, we work with Marcus, Colliers, everything, we do all their insurance. It was almost like a standstill, right? A mental standstill, where now everyone's adjusted to the current pricing, the 5.5 caps. And I'm seeing like Daniel Cunningham at Marcus had his best first quarter in 24 months, transaction volume, right? Whatever it is, hundreds of millions of dollars. So what does that say? It says the capital is understanding that Florida's still growing, demographics are still strong, people migration. Now ultra high net worth capital is bringing in family offices. When ultra high net worth people come to Florida, and like the CEO of Starbucks, they don't just they bring family offices, capital markets, capital raising, Brickell's and New Wall Street, Palm Beach, all of that stuff. So you're seeing that capital that will continue to invest in Florida. And I think overall, the market, I think we have a 4 to 6 year window here where it's going to be, let's call it, not like hyper accelerated great, but it's a good market. It's a good market where you and I can buy deals, feel safe. I think your downside is very minimal, right? And smooth, stabilized growth to high side, high velocity capital growth. And the last thing I'll throw in is look what just happened because of the war in Dubai, our sister city. Yeah. Miami and Dubai are now the first and second of brand name developments, right? Armani, whatever it is, Ritz-Carlton, Mr. C's, Faina. I mean, from what I hear, I've been to Dubai several times in the last 24 months, that market is scared money right now. So as you know, if your money's not moving, it's not growing, it's not being invested. And there's a lot of family office development money. Where is it coming? It's coming here. Because I go to the Miami Dubai Chamber and some of those founders. So another fuel for Miami. So yes, I'm bullish on South Florida.
So I think of like the difference that you said, like Star Island, 10 million, now it's 100 million, right? So I always thought about that. I said, okay, how many total homes, Miami-Dade County, over 5,000 feet on the water, right? Because if all the billionaires are coming here, that's always what seems, right? It's basics of supply and demand. 300 homes over 5,000 feet on the water in all of Miami-Dade County. There are smaller ones, right? But because people want privacy and they want, and they want space. So I always think of that's, so you're gonna have that. But the thing that I'm seeing is, what did I see recently? The middle income, to be middle income is about $170,000 a year. To be able, right, and then that's gross, and then after tax, right? So you're making, let's say 120. So it's 10 grand, right? Let's just call it 10 grand a month. But what I see is happening, and even in Broward, is that first of all, we need workforce housing units. What do I think about? Under $2,500 rents, under $3,000 rents. Let's just say for a 2-bedroom apartment, because then you're not going to have people, right? So they can move here. I remember speaking to the mayor, said we need 100,000 units, workforce housing units in Miami-Dade County. And the governor said we need 500,000 in all of Florida, workforce housing units. So we have all that dynamic, and everyone's like NIMBY, not in my backyard. So I think of, there's demand, but people, that's gonna be, from a real estate perspective, that's just going to be a deep need. I don't know where that's going to go. Workforce housing.
Yeah. No, I know. Well, they designed the Live Local Act, right?
Right.
And a couple friends of mine who are large, again, people don't realize the impact of the Live Local Act unless you become a real expert in it. And one of the rules is it demands that any new development, if you, it has to have a certain amount of workforce housing and affordable housing. But the benefits are the zoning, the speed to entitlement, the speed to permitting, the speed getting out of the ground, and that tax abatements, right? Yeah. So there's a lot of new people entering Florida, especially coming out of New York. Even I own an office building with 175 feet of frontage on Biscayne. Right now, I can do 290 units there. Now, before Live Local, I was Zone B1, right? I was only allowed to do a little retail and a little office, and it completely changed the dynamic. And by the way, you don't even have to go to the city to get those permits. You can go right to the state, and they overstep. So all of a sudden, the Live Local Act gave an opportunity to create high density, drop setbacks, drop parking requirements because we're going urban, New York, whatever you want to call it, and the state oversteps the city, and next thing you know, you get 254 to 300 units on a piece of land that, if it was zoned that way, would have sold at 4 times the price. So I like the Live Local Act, and as a developer, as a real estate owner, it really changes the game on that. And that's also the beauty of these podcasts that you do, that I do, is that there's so much capital moving from out of state that don't understand any of this, right? And they're buying a stabilized value add at a 5.5 cap, trying to raise rents. Those are the people, anyone can do that. It's commoditized. So I believe, because of the Live Local Act, because you know the mayor, because you know the Miami Beach zoning, because a good friend of mine sits in the Broward or Fort Lauderdale zoning department, if you don't understand that, insurance, lending, right, speed to the market, the construction costs, where's the labor pools, I'm seeing more and more groups, I know this is a little off topic, coming out of New York, buying a piece of land in Miami Beach,
I've seen that.
and buried for 4 years because they think it's just as easy as it is up there, which it's not, but they don't know the local systems. So that Live Local and workforce housing, it's an opportunity. I mean, drive by the Hard Rock, right? Casino. All of a sudden, there's 6 towers going up on 441 where there used to be a gas station that was vacant, and you could buy the dirt and the corner for $10, $15 a foot. Live Local changed that. So again, I'm super bullish on Florida, our government, being proactive enough to think like a with a kepi, you know, like, and you don't see that anywhere else in this country. Such proactive urban planning, thinking about workforce housing, lower income, middle income, right? Because who's going to fill all the AI and robots aren't going to be waiting, you know, by the fountain blue at the pool, probably for a good 4 years. Right?
Yeah.
So on.
What do you think? You know, I know that real estate in general, it's like the oldest, right? Owning land. You talk about AI. How do you think that that's going to affect, in general, real estate over the next 5-10 years? I'm Moshe Popek, and I just want to say thank you, genuinely, for listening to Common Denominator. If you've been getting value from these conversations, if something sparked a thought, challenged your perspective, or helped you in your business or life, I have one small favor to ask. Please subscribe to the show wherever you listen to podcasts. It might seem like a small click, but it makes a massive difference. Subscribing tells the platform that this content matters. It helps us reach more thoughtful listeners. It helps us book stronger guests. It helps the show grow.
I think there's going to be a huge disruption. Anytime there's technology, there's just disruption. As far as AI will definitely disrupt certain classes of real estate. And I think some will not exist. One that I debate about is student housing. So you think about it, where we are today with AI, right? Does this mean that enrollment at major universities around the country, is it going to drop or increase? Because today, you know, we recruit from FSU School of Real Estate. University of Miami has a massive school of real estate, right? And guess what? Like, I built a Claude program. I put in the 21 Nobel Prize winning authors on real estate underwriting and development, multifamily cap rates, IRR structures. And I put it in there. And in around 15 minutes, I uploaded my deal. And in around 1 minute and 30 seconds, it came up with 21 different ways to value add, underwrite, add something different, an ecosystem, a unique, how do I create a higher rent premium, all that stuff, and it's done. So now I could do that because you and I have the domain, right? How do we make more money per square foot? How do we increase the rents for this? What's a value add that would separate this from all the neighbors? But it can be done in 10 minutes with the right prompting and the right books programmed into it, right? From somebody who's a Nobel Prize winner real estate underwriter. We've done that. So how does that affect student housing? Enrollment in schools, remote, right? Are we going to be learning how to use AI and learn a domain? I don't know. So it worries me. There's something called AGI that's coming that they're all trying. That's why Meta's spending billions in all of them, Google. It's artificial generative intelligence. Today, AI can't teach AI. It needs you and I to teach it the domain of real estate underwriting and which books to upload. But once AI can teach AI to do that like us, the processing speed, the intellectual capital, we're not going to be able to compete with it. I mean, right now, AI can beat 1,000 chess champions in 3 seconds.
Yeah.
So how does that work? So think about student housing. So if enrollment drops, student housing drops, it's going to disrupt it, right? Certain office buildings. I know people always say, yes, office and Citadel's building a new tower. I don't know about that. High risk, right? And then when it comes to construction costs, robots are coming. AI is coming. All of that stuff. So it's interesting, but there's definitely self-storage I saw being disrupted with AI and technology. There's 3 companies in San Francisco, most of California today, and 1 in Texas, that it works like Uber, but you share your garage. Because the AI is able to build it in 5 minutes. An entrepreneur can launch it. They can build the marketing on Instagram. They can do it. It can be optimized, done quickly, scaled up, apps downloaded. The next thing you know, self-storage has been disrupted because autonomous vehicles are coming. Your car is working for you. Your garage is open. Now, self-storage is disrupting because it's now used as Uber, where you and I are renting our garage to each other.
Yeah.
So you have to pay attention? 100%. And then there's new asset classes, right? Which the biggest one I see coming, besides data centers, we know all that, right? And AI, but is also, what do they call them? They call them sky, like airports, right? And sky terminals. And it's already happening. There's 2 companies in Miami. Stephen Ross is building the first, I think it's called a Skyport. I've seen the plans, I've seen the renderings. It's going to start off at Dolphin Stadium. What a smart developer Stephen Ross is. You thought he bought the Miami Dolphins? No, he bought the biggest piece of land in Dade County. Genius. F1, tennis, Dolphins, and now a Skyport, right? Infrastructure. He's got all his developments. He partnered, I forgot the name of the company. I think it's called Chaser or another one. And now every new development, all the zoning boards, he's lobbying, he's pushing, each one will have a automated self-driving, self-flying taxi, electric. And it's coming. And the governor already said, approved them, and Florida's going to have like a highway in the skies. So I always say there's 2 kinds of people now in Miami. There are those waiting in traffic, and there's another company called Miami Island, which is the helicopter guy.
Yeah.
So I don't know if you've been seeing it, but he's got huge traction. He built like a 40-foot barge with 2 motors, and it lands helicopters. So you now have people coming from F1 on a helicopter, landing by their yacht, right, in the floating dock. A little 40-foot Von Dutch takes them to their yacht or their house, and it's done. They're avoiding all the complexities because of, since it's a mobile stationary thing, it's more like a boat, so they're allowed to land there. So they figured it out with the FAA.
Love that.
Right, but what did it just do to the price of real estate? Now you own a piece of waterfront property, and you're able to land your little Uber electric, sky helicopter, which will be autonomous, right, within 2 to 3 years, and they'll have a pad. The Ritz-Carlton, the new one, they designed with a helipad now, floating helipads. So it's new asset class.
Yeah.
What happens when in New York City, when you put a subway station at 86th and Lex to the real estate around
The whole real estate blows up, for sure.
Exactly.
For sure.
What happened with the Brightline stations?
Yeah.
Same thing.
Yeah.
So
I mean, I did see that the bonds aren't trading that great, because the thing is, I always compared the Brightline to Tokyo. It's just not right. It just takes the same amount of time, and you don't get to your final destination. That's the problem. But we'll see how that ends up working.
That was
out.
a real estate play by private equity out of the
100%.
Northeast. Yeah, 100%. They bought the bankrupt railroad.
For sure.
Genius. But it can't make money. It's got to be a private-public partnership.
100%. That's the only side of it. But and also going back to the idea that I'm watching all these. I get all the calls from people. My family's originally from New York. They want to come down here. People from California, from all over, and I watch them because it's so nuanced. They don't have the local partnership, and I remember learning that in business school. To that point that you made, you must have that local knowledge. Otherwise, you're just going to be stuck, and you just don't get to the profit center. What is the strategy with insurance? I know that that's a big focal point.
Yeah.
When it comes to real estate.
So for me, insurance was blindsided me here. I moved again from New York after the dot-com bubble and so on, 9/11, moved to Miami Beach. I had a mentor, Ben Schulman, who owned Tiger Schulman Karate School, if you remember that. He was a great guy. Showed me how to buy multifamily in Harlem, and then I started buying in Miami Beach. Long story, by 2005, I got up to 144 value-add, Art Deco, type of units. It was my first real estate play. I got a Fannie Freddie cash-out refi. Crazy insurance guidelines, and I was with a national company like a Brown and Brown or whatever you want to call them. They're all bought up today anyways by private equity, and I was paying roughly, let's say, $800 a unit all in, right on 144 doors. All of a sudden, Wilma came through as a category 1. Katrina came through, remember, buzzed Florida, and then went to New Orleans and did that. Now my renewal was December, right? So I'm not thinking anything. I have it, it's an expense. I know what my NOI is, my DSCRs, I have investors, the whole thing, right? Paying, and all of a sudden, where's my insurance renewal this first week of December? Where is it? I call Brown & Brown, of course, 72 hours before. I love to do this. I get a quote for $1,800 a door and a 10% wind deductible. Can't meet Fannie Freddie guidelines, which are completely ridiculous. So I'm like, okay, do the math. That's whatever it is off the top of my head, $150,000 in NOI blows up in my face. Well, as you know, on 144 units, at average rent back then was $800 or $1,000 a door.
Yeah.
You take that out of my NOI, I'm underwater. More importantly, on $100,000 at a 5.5 cap, I just lost 1.8, 1.9 million in exit value. And if I did need another refi at, let's say, 6%, 30-year AM, probably $1.1 million in loan proceeds. So how do you operate in the state of Florida? Come from New York, which this doesn't exist. Even Superstorm Sandy didn't do it. And by the way, we made no claims. There was no damage, right? And I can't make claims because real estate is commoditized. My cash on cash is what, 9%, 10%? You take my insurance up by 100,000. Now me and my investors are making 5%. So the point is I couldn't allow that to happen, and it does happen. And if you're from the Northeast, especially Chicago, any stabilized old school market, this does not happen. There's no natural disasters in Denver, things like that. So what we did is we brought insurance in-house. So we opened up, at that time I had Investors Realty, Old Florida Mortgage, Black Marlin Capital for real estate. And I brought it in, Doug Levy, a friend of mine, he knew insurance. And I thought I was going to first capture the commission, which can be 12 to 25% on your policy, by the way, and not get railroaded within 72 hours, right? Because how do you tell your investors on your next quarterly update that happened to you in South Florida? And you're like, oh, you're blaming on the hurricanes? They don't care.
Yeah. It's business. It's straight business here. You got to come to solutions. Yeah.
So we brought it in-house. We understood the beast after many years. I understood the markets. We got the contracts. We formed an independent agency. And what the biggest things that I realized there is, number one, it's a commission-driven business. And it's owned by private equity. They've rolled up every place. There's no more independents, the Risk Strategies, the Brown and Browns. Everything is profit-driven. I can quote you a simple 8-unit with ICAT. It's a carrier. I have a direct carrier appointment with them. Let's say it's $1 million in coverage. If I go direct, it pays me 10%, and your policy is $18,000. I can go to a wholesaler, right, for $1 million in coverage and liability, pay me 22%, and your policy is $26,000. So that exists in the industry because in Florida we use something called E&S, excess and surplus. It's not admitted. It's not regulated as much. So it's a wild west, just like the NASDAQ, just like what caused the GFC. And the next thing you know is, how do you know that the agent you're working with understands your NOI? because you don't know. He doesn't care. Or the system is designed for commission structure and to sell you a higher this and things like that. And by the way, 90% of the stuff out there you don't need. So what we did is we figured that out, number one. Number two, what we did was realize the importance of the lender, right? Because if you go Fannie Freddie, here's how they work. Fannie Freddie, you want to borrow non-recourse debt, right? Obviously, we love non-recourse, cash out refi, underwrite on a spreadsheet. They just look at your leases. It's the easiest debt to get, best rates, usually best terms. But yet, if I do that, the insurance requirements are 90% higher than you will ever use. Why does that happen? So you need domestic terrorism, increase of 6%. When's the last time we had domestic terrorism? Or as an entrepreneur, do you think we're going to have domestic terrorism? Do you want to spend 6% on a $100,000 policy? Or do you want $6K in NOI? We have 18 months of business income coverage. Last time I checked, the fire department in Dade and Broward respond in 6 minutes. And the average fire claim is $60 to $120,000. And most of it's done by the fire department damage. And by the way, are you going to wait 6 months to churn your units? Because they don't pay you that income for 60-day wait. Never use it, right? Then you need full value flood. FEMA takes care of the first $500,000 on your building, a couple thousand. Fannie Freddie, if it's an $8 million building, they require $8 million in flood.
Yeah, it's ridiculous. You have
For
to
what?
fight that, yeah.
So the point is because you borrow money from the Fed, then they do that. And then you have insurance requirements and the lenders. So if you follow the money in the capital, the banks who are lending the money on the loans and everything are lobbying the federal government for the standards of Fannie and Freddie and all the insurance guidelines. And when that happens, they're basically saying, if you want to borrow money, it's these rules. And by the way, I also invest in all the insurance pools.
Of course.
All the insurance programs.
The banks own the insurance companies.
Banks own the insurance companies. So if you want to borrow non-recourse in my term, I got to sell you 90% of insurance that Moishe and me will never use.
That's right.
Ever. And it's ridiculous. And what I say is I'm disrupting today a greedy insurance industry, and I'm giving back the fuel to the titans of American real estate, which is capital, right? So they can continue building workforce housing, providing retail, providing stores and things like this. And today we can reduce your insurance almost 80% with proper coverage through specialty captive programs, a system we have called total asset optimization, and like most of your properties, his dirt's worth 4 times the structure. So we have banks and alternative lenders that understand that, right? They'll waive wind because if he loses his building, he doesn't care. He's already doubled his money on his dirt.
Yeah.
So it's the real world of total asset optimization. And now we insure almost $5 billion in Florida because we talk like real estate guys. And by the way, my biggest challenge is I can't recruit from the insurance industry because they don't get what we're talking about. Yeah. They don't understand NOI. They don't understand cap rates. They don't understand debt, DSCRs. They understand coverage. And the saddest thing is we can't even make a claim because if you make a claim, your policy will go up 30 to 40% a year, kill your NOI, or you'll just get canceled.
Right, because you even think about 70% of premium is the hurricane piece. Correct. And if a hurricane actually comes through Miami or Fort Lauderdale, the end of the day is if you look at the sustainability of the financials of the insurance carrier, plus the deductible, you're actually not going to you're actually not going to get paid. And that's really what it is. It's the commission based, like you're saying, and then that the banks actually own the insurance companies. 100%. So what you do is if you have a very, very good broker or yourself, first of all, you try to cut out the retailer, deal directly with the wholesaler, or go. There's so many layers, but so many layers. Know, and then you have to negotiate with the banks, and hopefully you have economies of scale that you have negotiating power.
Correct. 100%.
Or you go to a bank, that has that, and then if you have a big enough pool, you also can have loss limits, which means that, right? If you have, let's say, $50 million worth of value, maybe you can get it for $20 million. Maybe you can get only $20 million.
Right. Maximum loss formula. Things.
Yeah.
That's actually thinking like an entrepreneur, right? So you evaluate retail holdings, multifamily. You and I evaluate real estate. We evaluate the lender we want to use, the terms, the NOI. What investors do I want to bring it in? Do I want to use my own capital? Do I want to, bring in a syndication? Is this a covered land play, or is it really a multifamily long-term play, right? You and I will evaluate that 78 ways. But the most sophisticated real estate investors that I've spoken to, why don't they go down the rabbit hole of insurance, right? Because just like you said, if you and I designed our own policy for this building in Miami Beach with investors that we have a fiduciary, what would we insure? What's the land value? What's the real replacement cost? What are the real risks? General liability, assault and battery, firearms, lawsuits. I have a fully concrete building, sprinklered, right? The fire department. So the actuaries understand this in insurance. But as investors, we go to a bank. We focus on rates and terms, not all of us, 95%. And then they don't even ask for the insurance requirements. You already give your good faith deposit. You lock it in. You lock the deal. You raise the capital. Oh, by the way, your insurance estimate was from 2 years ago from the seller. It was $41,000. Our new requirements are $160,000. We need another $1 million in equity.
That's right.
Yeah.
That's right, because it changes the whole underwriting 2 weeks before the deal's supposed to close.
Exactly. And then they called me in a panic, and I said, "Why did you use Greystone?"
Or no, that's definitely.
There's local banks that will waive a lot. Local banks get it. Local Florida, like City.
I mean,
National.
you have to deal with the personal guarantee or a limited personal guarantee on some of that stuff. But
Correct.
What would you say is just thinking about this, because I always like to learn from past experiences. What would you say was your worst business move? Would you say
My worst business move,
or the one that you learned a lot from?
Yeah. I mean, it was okay. So the worst business move that I did, it would have to be pre-Florida, right? Is not understand how the universe works, let's call it, believe it or not, as a macro subject. Meaning, I'm a Russian immigrant, right? Born in Moscow, Israel, Brooklyn, ended up in Michigan because my father was an engineer, Detroit, and so on. And we didn't know the language. The good news is we were in a wealthy neighborhood. My dad was smart enough to rent an apartment, as we learned. My mom worked at Dunkin' Donuts, so the whole thing. Me, my brother, and my mom's parents. So I grew up with an insecurity that I didn't have enough money. And if you remember back in the 90s and 80s, they had a sign that said the one with the most toys wins, right? It had jets and limos. And we were taught in the late 80s, that money and the credit card was born, shopping malls and everything. So after I went to University of Miami, I ended up living in Florida, and a buddy of mine at 22 years old pulled up in a Ferrari right here. And I said, "Where are you?" He goes, "I work on Wall Street in New York City." I go, "Where?" Place called Stratton, Oakmont, Jordan Belford, right? Wolf of Wall Street. So in 2 weeks, I was doing telecom sales for AllNet, because I always said, how do I make the most amount of money with the least amount of effort, which is either real estate business, recurring revenue, or money. So I was selling telecom, right, to offices. I got in the car, drove to New York, got my Series 7, and went to work for him. And it wasn't that Jordan Belford was doing something wrong, because they all did that. It was unregulated, NASDAQ. We would call them with Intel, the Disneys, everything. What we were taught is how to call ultra high net worth people around the world. We're your eyes and ears on Wall Street. I am your New York bookie, and you're going to brag about me at the country club in LA, Minnesota, or Palm Beach, right? So I ended up working at Lehman, believe it or not, in Gruntle, because I didn't want to live in Long Island. That's it. So I did it, I learned, and I had about an 8-9 year run right into the dot-com bubble, right? Back then, I made a couple $1 million before 30. I bought a condo on 160th and 62nd and 1st, right? And that's where I met Ben Schulman, my later mentor, who owned Tiger Schulman Karate. He made his money in multifamily and trailer parks in New Jersey. He rode a Harley, and he went to this Chabad. That's how I met him, and he ended up being my client at when I was either Lehman or Gruntle. And he used to show me how to take burned out buildings in Harlem and 125th, 128, and buy them from churches and convert them to Section 8 multifamily. And him and I, but he had around 10% of his holdings in the stock market, right? So what I learned is I got really good, meaning I could pick up the phone, and I was taught to call C-level suite people in Texas and raise $1 million on WorldCom. If you remember that, or Intel, that was $12, right? And if I'd ask them for 1.2 million, I'd get 100 grand and we would make 9%, right? It was crazy, right? And what I was taught by all of Wall Street was stop being an analyst. You can't pick good stocks. You pick what pays you the most. And they were right. If I bought them Intel, they got pissed, Disney went up. If I bought them a bank stock and it was flat and only paid a 3% dividend, they got pissed. So we were taught just to sell. And in that time, I learned about cycles. So I learned that we were pitching the dot-com bubble, and this is the birth of AOL, right? Netscape, right? We were pitching. Lehman took a company public called Webvan. Webvan is Grubhub. I'm using a 56K modem to run a NASDAQ quote. My phone didn't exist, and the stock went from 0 to 100 on a grocery delivery company that would deliver groceries to your door off the internet. Well, you didn't have a cell phone. We didn't have processing power. We didn't have 3G. We didn't have anything. So why did the stock go to 120? Irrational exuberance, commissions, greed, all of that. AOL destroyed me. The dot-com bubble. Yes, let me say this. 4% of the companies today are still here. You have Google, Apple, Microsoft. They were the survivors. The other billions of dollars of capital that your mother's pension fund and teachers' credit unions that we placed was destroyed. AOL, Time Warner bought them. They're gone. AOL was, we got mail. No one understood how far the technology was away, right? This is 98, 99. And then what happened is I made millions in commissions, bought condos, and then it blew up. And when it blew up, so did Jerry. So I got caught up into the market. I had a $60,000 market call. I had a lot of $5,000 suits. My boss made me walk across the street with my first commission check, 11 grand. I had to buy a Rolex, right? And I had to buy this. That was the mentality, right? Pressure will turn you to coal. And a lot of people couldn't make it, but I was flat broke. And I had a condo in Manhattan, paid $160,000 for a 600 square foot one bedroom. I called my realtor and said, how much is it worth? She said like 3. I sold it, paid my margin balance. And I said, what did I learn? That the universe is not about me, right? So what did I learn? I thought that being a good business person was making money for me at all costs. I was a bookie, right? I could sell ice to Eskimos. I could sell Dr. Bloomgarden in Scarsdale, $400,000 with a bank stock that paid me 12% commission, right? No problem. And make 12 grand on a phone call, 8 grand on a phone call. But in the end, what happened? I lost everything that I built. And I have a need to be liked. That's why I have a podcast. That's why I have a personal brand, Jerry Katz, CEO. Like, you just feel like shit, right? But you don't get it until it blows up in your face. So that was the worst business mistake, meaning that it was the biggest learning moment of my life, that I kind of started to realize what I had been taught my life, or being spiritually, or faith, or getting bar mitzvah. All of a sudden, everything that one of my rabbis who's a mentor has taught me, it was like, what? He'd been telling me this my whole life. Things like, I breathe out carbon monoxide, that tree gives me oxygen. The universe, God, physics, whatever you want to call it, is created in a symbiotic relationship, right? Right. And it's not created to build you up, right? The creator, however you want to call it, he created a place where if you ask me, what's the purpose of business? What do people say? To make money. It's not. It's to solve problems. It's to get workforce housing.
It's actually a spiritual journey.
100%.
Business, right? I had a friend who was not really affiliated, and he said to me, if someone doesn't believe in God, put him into business.
There you go.
It's always what it is. But Jerry, I want to say I love the energy and I love the insight. I really appreciate your time.
Thanks, man.
And we should all do well. And I'm a huge proponent of Florida, Miami. I think it's gonna be great. I think we have at least another 10 years.
Yeah, no, I agree. And it's great because I only come on podcasts that I have alignment on values and spirituality. So I've been watching Moshe for a long time. He's a couple of years ahead of me in his launch and his traction, but I love it. I can only be on a podcast that someone shares the same values. And once I lost it all and realized how things work, that it's never about me. It's always about helping others. And I am more rich than I ever thought I would be, right? I get more opportunities. I'm on his podcast than I ever thought. And today, that's my core. And once you figure that out, you can sail through life with your sails full. And no matter even something bad happens, it's just a learning lesson that you're not ready yet to understand the big picture.
Jerry, we'll do a quick rapid fire. Best investment you ever made?
Best investment, education, skills.
Worst investment? We talked about that.
We talked about that.
A book every founder should read.
7 Habits of Highly Effective People.
A most underrated wealth building skill.
Tax efficiency, understanding, like I don't pay taxes, you don't pay taxes, but the most wealthy entrepreneurs that I know that are not involved in real estate pay taxes that are unbelievable. I know an event planner who throws he owns Ultra. That guy's paying $4 million a year in taxes. He owns no real estate. And I look at him, I'm like, what? So you have to understand tax efficiency. My tax depreciation and cost segregation a year is like a 15% cash on cash return.
That's right. That's extremely important. People don't understand that. And you have to get a tax strategist, not an accountant.
Correct.
Tax strategist. If you don't know numbers, you got to really understand it. One thing wealthy people understand differently.
The majority of the people that I respect in business and wealth, family, they understand faith and spirituality. I'm in rooms with Naftali, billion-dollar developer out of Manhattan, 50 projects. We do insurance. Every room that usually has a billionaire, the conversation always ends up on value systems, building relationships, having faith, and understanding how the rules of the universe work. That is such a hyper differentiator. I've been in a room with a lot of billionaires. There's only 2,800 in the world. And I don't care if they're from Saudi Arabia, from Israel, from California, or from Mexico City. They all have faith.
I think of like the highest level being surrender and acceptance. You don't play by the same rules.
Correct.
You understand that there's other things. And what does common denominator mean to you?
Common denominator is everything. It's a great freaking podcast name. It's why I'm on the podcast. And if I just peel it back and make it simple, it's because I know Moshe and all these business success people, we share common values, right? It's not, when him and I sit at a table to make a deal or anything, the first thing we usually ask is, what's in it for the other person? And how do I make it work for them? So that common denominator, that when you build around a value systems and every business deal, every employee, every contract, you make sure that both parties are taken care of. That is a common denominator that one deal, one podcast leads to 100, right? And so many people don't understand that. They come to the table.
I've said it on the show many times. And that's when it was like, when you figure out like, okay, what's going to be the scalable thing?
Correct.
Right? It's, okay, how do I make money for everybody involved first? I'll make money last and give me the worst problems.
Correct.
Right? Most people don't want to do that, like you just said, Jerry. But
No.
that's the answer. And we're saying it right here. Constantly do that consistently, you'll make a ton of money.
Right. And people show up like, what am I going to get out of this?
Right.
Guess what? You show up like that, you may get 1 or 2 deals, but that's it. It's not going to work.
Never.
And by the way, him and I, we can right now underwrite any deal, right? I can change 2 or 3 rent growth numbers in this. It changes the IRR to 24%. It looks fantastic. If you don't underwrite operators and peoples and our value systems and how we think, you might as well just burn the check you wrote because you're going to lose it. It's not about underwriting. We only underwrite the people that we surround ourselves with all the time, personal, family, business.
100%. Thanks, Jerry.